My name is Neil McIver of McIver Capital Management at Canaccord Genuity. The best piece of advice is very simple. Be skeptical. Often, the best thing that can happen to a rookie investor or a new investor is that they lose money, because then they build skepticism up. There's a lot more sizzle than there is actually beef, and that's a very important concept when it comes to investing. I've never seen an investment proposal, nobody's ever come to me with an investment idea that ever lost money. But of course, we all know the reality is many do, and in fact, most do. So skepticism is the number one primary thing to bring to investing for the very first time. You know, a lot of people assume very many, and yes, I know there is a truth to it. I did at one time write a speech for a prime minister, or certainly a part of it. And I'm sure everybody there probably thought that I had many. But in fact, I never did graduate from university. I began in the investment industry immediately after high school, left for a while, was in the construction industry, turned to the investment markets because that's what I was passionate about. And that's where I built my career. So all of my experience, all of the degrees that I do have are all industry degrees. So they're all certificates based upon my experience in my 30 years in the marketplace. Of course, I respect everybody, and I hire people who have tremendous university degrees to work at McIver Capital Management. But I myself have absolutely zero. The greatest concern that I have for my clients is that they have a lack of finances at some point in their life, and that we somehow did not foresee something coming down the road. We are always scouring the future. We're always taking a look into the future. We're skeptical about what we see, and we're very careful how we step, because we know that we have our client's future in our hands. Remember, we're fiduciaries, and being a fiduciary, we're legally responsible for the outcome. But even if I wasn't legally responsible, of course, from a personal perspective, we want to ensure that our clients are able to achieve their financial goals and that they have enough capital into the future. So my greatest fear, my greatest concern is that clients will not have the resources that they need at some point in the future, and particularly now with inflation, that's a bigger issue than ever, and we've done a lot to protect our clients, and we'll continue to do that. The number one is inflation, because inflation is the great thief. It steals the future value from people. And what it does is it decreases your purchasing power. If you retire with $5 million and you've got, say, 7 or 8 or 9 or 10% inflation, every year your purchasing power from that $5 million decreases very, very significantly. And your wealth on a relative basis is decreasing. So my greatest fear for my clients and my greatest concern economically is that inflation is going to eat into their capital and their wealth. So we build portfolios that are properly allocated, they're properly structured in order to, they're like tanks, to get through to the other side of the battlefield no matter what's thrown at it. So we're always going to be taking inflation considerations into how we structure portfolios. We own things like real return bonds that rise with inflation. We own things like commodities that rise with inflation. We own things such as food production that rise with inflation. Things that are what we call positively correlated to inflation, we build constantly into portfolios in order to protect the wealth of clients. But we don't do it willy-nilly. It's all based upon a mathematical formula, and the amount and the percentages are dictated effectively by math and science. I think that's a tremendous question, and that's the question, I think, of the last 2 years, because we all knew 2 years ago inflation was going to work its way into the economy. And we began 2 years ago increasing our exposure to gold, because gold, of course, is a store of value that has a great inflation hedge that's automatically built into it. So we've been doing that. But also about a year ago, or more than a year ago, we began to build some crypto into our client model portfolios, only in the right percentage, of course. for the very same reason, because we felt that it would be a reasonable hedge against inflation. The truth is it may be a hedge against inflation, and I think we'll find out over 2022, 2023, and beyond, but that's not yet been determined. It was felt that crypto would be, and certainly Bitcoin would be, a safe haven asset during times of tremendous amount of volatility like we saw in the COVID correction or COVID collapse at the beginning of 2020. And that didn't happen. So while gold did hold value and it was negatively correlated to that correction, Bitcoin was not, and it came down just like every other financial asset. So I think while Bitcoin may be positively correlated and protect against inflation, it hasn't necessarily been negatively correlated to the stock market as a whole. So it'll be an interesting 2 or 3 years in front of us. That's another very good question. I do, and it's pretty simple. It's work hard and be nice to people. And if you follow that, you can never, ever, ever go wrong. My name is Neil McIver of McIver Capital Management at Canaccord Genuity. Thanks so much for listening.